What about you for volatility? Is it a good thing at the moment?
It's an opportunity for us. About 4 weeks ago, we went to about 44% cash. Actually, that was about five weeks ago. And we're now 55% cash. So this sell-off in the equity market that we've experienced is actually, we see it as an opportunity.
Yeah.
We just had our investment committee meeting yesterday, on Thursday, and what we did discover though is the sort of companies that we want to buy aren't cheap enough yet.
Right.
And we're fortunate that in the Montgomery private fund, we have a lot of some very high-profile business people and leaders in industry and entrepreneurs, and we have a lot of dialogue with them about what's going on in their particular sector of the economy, and the picture isn't encouraging.
Yep.
And so for us, we're delighted to have that much cash, and we see lower prices inevitably. And that means we'll be able to pick them up cheaply.
I'm going to ask you a question without notice. Newcrest.
Yeah.
I'm not an equity guy, but Newcrest came out with a profit downgrade. The prices get belted. You know, all the analysts came out with some commentary. A lot of people came out early and said we think there'll be a profit downgrade, and then there's been some analysis around. Hang on, did they do this properly? What's your interpretation of how that all played out in the press? Is that something that's of some concern, or did they just do what they're supposed to be doing?
No, in fact, I remember being on this very program, not with you, Mark, but with Chris Kimber and Ben Clark.
Yep.
And we went around the table asking what our valuations were for Newcrest the middle of last year, or actually earlier, maybe a bit earlier than that. And it was trading, I think, around the $30 mark or $35. And our valuation was about 15, and we were laughed at, as you can imagine. Clearly something's wrong with us, and here we are.
At 15.
So we think Newcrest is singularly the most expensive, or it was the most expensive gold producer in the world that was listed, and our valuation was significantly low. We couldn't justify it.
Yeah. Yeah. You and I spoke about Cochlear. We were thinking that was a good, buying opportunity.
So we've
it
owned
was in
it
the
a couple
60s
of times.
and 70s.
Yeah, we've owned it a couple of times, and we still had a little bit of stock left when the announcement came out, the latest downgrade. We didn't have a lot; it wasn't a huge part of our portfolio. But having said that, the stock has since bounced off its lows, and we think there's value at lower prices. However, we're a little bit curious as to the fact that there's been very little growth in profits since 2009. So we think that there's something more to it than just this latest situation where there's been a holding off, a supposed holding off of purchasing of cochlear implants ahead of the release of the new product. We think there might be more to it than that, but we're just going to wait until the full year results come out and have another look at it then.
Are they being caught up in, and in Cochlear it might be different because they're talking about the competition and affecting their profitability and their moat and all that sort of stuff. I understand all that.
I think it's overstated.
I find that very hard to understand. I read the report, and this is what we say about people in fixed income. We look at the report. We're often talking about Sydney airports. We're often talking about these organisations. They have very substantial moats that if they were easy to break into, they would have done it on Monday. They would have broken in on a Tuesday. They would have done it earlier. The stock market is illogical. That's what's so great about the stock market. Or so terrible if you're holding Newcrest.
Yeah, well, the key is obviously to make sure that you're in the best quality businesses and you've bought them at below their valuations.
You tend to find that out after it's gone up and you become the flotsam and jetsam as you're trying to say, how do I get a performance in CBA's at 73 down to 65 or whatever it would have gone to.
Yeah, look, I think too many people focus on prices and they don't focus on valuations. And the key is very much to focus on intrinsic values, which change much more slowly than the price.
Yep.
And if you anchor yourself on valuations, then you see the price for what it is.
So you're not as concerned about the volatility?
Not at all, it's an opportunity.
Volatility was driven by, Bernanke blinking. He was in an unpleasant environment. He was talking to a Republican. The Republican said, will you consider unwinding? Subject to the data being
Tapering.
good, we'll look to taper. Yeah, we'll look to taper. Yeah. The market sneezed. The market said that's terrible. We've got this heightened volatility over a couple of weeks. What do you make of it? What do you make of the idea that he hasn't actually looked to taper? He's just said consider it. Do you think that the equity market had lost oxygen at those levels already?
No, I think the bigger issue is that quantitative easing isn't working. Since it started in
They've lost
September
the belief in it.
2011, the Federal Reserve has expanded its balance sheet by 18%. Right? And they're now buying $85 billion worth of bonds every month.
Yep.
And yet inflation back in September 2011 was 3.9%. It's now 1.1%. So the statement was, and I think it was the St. Louis Fed president that came out and said, we will continue quantitative easing until we see a recovery in employment.
In the job market, yeah.
In the job market. So we're seeing that, but we should have seen prices stabilise at least, and we're not. Prices are declining. That shouldn't be happening. And I think the deflation concern is starting to mount. And if you combine the deflation issue, and Japan is now winning the currency war,
yeah, absolutely.
and they're exporting deflation, and everyone's cutting prices to compete. If you consider those two things, along with the fact that the World Bank has come out and cut world growth, emerging market growth is slowing, that's bad for commodity prices, those three things together, well, there's a possibility for an emerging market debt crisis again. And so the safest place to be is in cash. Now, that's not the reason we're in cash. We're in cash because things got expensive up at the highs a few weeks ago, and so we decided to take profit. But it makes sense to have cash in this environment.
We're going to go to a break, but Roger, you have 30 seconds to tell us your most important issue of the day. Let's go now.
Okay, so I believe that the Australian economy is at risk of a recession. I don't mean a technical recession where we get 2 negative quarters, but I mean it's going to feel a lot like a recession, and this is going to come from the recession that already exists in mining and mining services. That's going to present opportunities in the stock market because as the stock market declines ahead of a recession, prices will fall below intrinsic value, so you need to have cash to take advantage of that. The time isn't right now, but you need to be ready and sharpening your pencil.
It's Mark from Brisbane. Hello, Mark. How can we help you?
Yeah, good evening. Just a bit of a broad question. If I'm about the age of 35, and I was just wondering, and I have got some money at the moment, and I'm just wondering if you should split it up between 3 or 4 different equities, so like obviously stocks, bonds, some in obviously term deposit, and maybe some in real estate. I know it's a broad question, but with the stock exchange being a bit volatile still maybe going forward in the next 2 years, you obviously wouldn't want to put it all in there, for instance. And, obviously banks and all them sort of companies. A friend of mine's told me about a company called Seymour White, which is a road-based company up in Queensland. Those sort of more secure investments away from mining, is that the direction to head in?
Great questions, Mark, and there's a few of them. I brought a chart in, and I just want to point to this chart, and I think this might help Mark get some sense of it, and then I want to offer the thought. What we've done here is we've created a chart that shows, for the viewers at home, there's a green line, and the green line suggests if my expectations were inflation plus 3% over the long term, that'll be the green line. It's quite stable. If I look at the blue line is if I combined all my assets and I split them up and I had 75% equities and I had 25% bonds, that's the volatility, that's the amount of market movement I would expect from these indices. If I compare it to the opposite, where I do 25% equities and I do 75% bonds, you get a much smoother orange line that doesn't have the same volatility.
Which you should have put at the front.
Which I should have put at the front, but it was very short trying to get the people to help me on a Friday. Essentially the key here is that for long-term investing, if you are concerned about volatility, you need to go 75% fixed income, 25% bonds. Now, in answering Mark's question, who's under 35...
You mean 25% equities?
25% equities, 75% bonds.
Yeah.
Did I say something else?
You said bonds and something else.
Slap myself. 25% equities and 75% bonds. I'll now go against it and say that this is an age-based performance. It's about where you are in the cycle of your investment. So I feel, in answering your question, Mark, you need to, I think, what Roger's talking about is getting more up the curve in terms of investment knowledge. I don't think you should be getting investment advice from a friend that says buy a road-based organisation in Queensland. I think you need to, that's a great friend to have and just converse, but I don't think you should act on it. I think you should work on the education piece and be comfortable in what you're buying at an investment level, but buy a lot of equities, because at your age, you need more growth at under 35, and over time, start to buy some fixed income. Now, if you were to buy fixed income right now, if I'm Mark, I would buy the Sydney Airport Linkers at 4% plus inflation for the 2030s. I think that would be a great bond to buy, and that's the one bond I'd ask you to buy, but the rest of the time put your money into pretty much equities. Now, tell me I'm wrong. That chart shows me that somebody who doesn't have Mark's age, who is more in his 50s and 60s, he needs to start thinking, okay, I'm not going to lose an awful lot if I go 75 bonds, but for somebody who's 35, put it in growth.
I agree.
You know, have one thing, which is inflation.
You know, especially with self-managed super funds now, people are in, you know, they go to pension phase and they're required to take a set amount out. And the problem with equities, when you try and match those two things up, is you're forced to do the reverse of dollar cost averaging.
Absolutely.
You're forced to sell equities every year, even if the share price is low, which means you have to sell a lot more equities to get the required dollar value out.
That's why you've got to go through it.
That's a big problem.
But that's why you're matching with your assets.
Yeah.
So obviously you would put yourself in a
But
position.
it's not a concern for our 35-year-old.
No, Mark in Brisbane, but the concern is if you take the advice of Seymour.
The issue I've got, we've owned Seymour White before, and we know the business very well. We've spoken to management several times. That isn't one that's coming up on our radar as something that you should be interested in. Having said that, I would you do one of two things. Either become a know-something investor, which means you're actually going to learn how to identify businesses and value them. And if that's not the case, then you look for a fund manager that knows how to do that.
That you can trust.
Well, yeah, someone that you believe they know what they're doing. And I'm not suggesting us at all. You know, it's anyone that you believe they know what they're doing, and they generate good returns over long periods of time. Otherwise, you're going to do it yourself. But it's a lot of work to do it yourself, and then you've got your eye off your family, you've got your eye off your job, you've got your eye off all the other things in your life that are actually important because you're chained to a desk and a computer screen.
Is it that much different in terms of the amount of analysis you need to do on the fund managers? I mean, is it how much more work are we talking about? If I'm looking at some investments at some of the nice reval levels that you're talking about, I do worry about fund managers. They move.
Yeah. Well, the thing is, there's a couple of key ingredients. One is you want stability in the team. So you need the team to be stable over a long period of time. You want them to be incentivised. You want to make sure they own the business. Otherwise, they could go. You know, the guys picking the stocks. And you want to make sure that you're happy with the style of their investing and then their returns.
And if they stay consistent with that style.
Absolutely.